This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, with another episode of Energy Markets. You can learn more about us and our consulting group at commodityresearchgroup.com. Our disclaimer is that our podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone, especially those not intended to listen. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today, we are very pleased to have a special guest, Dominic Proctor. Dominic has spent the last 10 years as the manager of financial trading at Suncor Energy, and before that, almost 9 years at Nexen. He is recently retired. Welcome, Dominic.
Thanks, Jim.
Andy Lebow is also here. I'm going to turn it over to Andy with his first questions for Dominic.
Okay, thanks, Jim, and good morning, everybody. Dominic, I think I've known you for all those 19 years, so it's really a pleasure to have you on our podcast this morning as we talk about what's going on in Canada, which obviously is very important to the overall supply and demand for North America and globally as well. So the first question I wanted to ask you, Dominic, is U.S. production has exploded in the last 2 years. Last year, we were up 1.5 million barrels a day on crude alone. But Canada has last year grew, I think, 200,000 barrels a day on crude production. Why such a disparity in North American, in the two North American producers?
Yeah, the big difference, and you see it somewhat in some of the restrictions in the Permian and some of the expenditures there being slowed down. But Canada, as most people in the oil industry know, is landlocked as far as being able to get crude to the market. We, relative to how the United States has been able to add pipeline capacity to take their crude within the U.S. and now to export it, we've been stuck waiting for new projects to come on. And so just with this last year, with the 200,000 barrels a day that we've added, we've kind of hit the wall where we are now got more capacity than we have takeaway capacity, even using rail, which has grown rapidly in the past year.
And let's talk a little bit about, well, first off, Canada too, U.S. production has grown as a result, of course, of the shale revolution. Canada has, I guess, three separate types of crude production: the oil sands, conventional, and offshore. Do you think that Canada would still, the takeaway capacity issues, you think Canada could grow quite as quickly as U.S. production?
It definitely wouldn't be as much, but we do have huge reserves in the oil sands. But I don't know if we'll ever be able to fully exploit that, given the huge boom in shale oil, because shale oil is more economic, and I mean it's grown. I remember, and I'm sure you and Jim remember as well, back in 2008, where prices, WTI was running up towards $150, and all the talk was about peak oil. And I was just looking at an old article that was saying 50 of the 70 oil-producing countries had already reached peak oil. And since then, that was the low point. I think U.S. was producing 5 million barrels a day at that point. And so I think is the U.S. now approaching 12 million a day?
Yeah.
So the shale and most of that growth has been in the shale, whereas 80% of the growth in Canada has been in the oil sands. So it's definitely different resources, different cost structures. So Canada definitely doesn't have the same growth profile right now. And that's not to say that some shale resources may be discovered and exploited in Canada with time, but we don't have the transport for those resources either.
Dominic, a lot. Oh, go ahead, Jim. Sorry.
I was just going to ask you about the basis. Your crude oil, does it trade off of the Cushing price? How does that? What's basically my question is what's the price that we look at that producers receive?
Yeah, the primary oil stream in Canada is the Western Canada Select, which does price off of a WTI differential. Now that took a look at that, and over the last 10 years, that differential's averaged $17 below WTI at Hardisty, Alberta. And given that it's ballooned out a couple of times, I would say the median price of that has been about $15 below WTI. So it's a lower grade. It's a heavy similar to Maya and some of the California heavies with its qualities. Right now, that has rallied up to a differential of less than $10. But last October, I think it traded as wide as $50 below WTI when WTI was running up towards $75 a barrel. The Western Canada Select was not running up at all. It was mired, and that was the result of the bottlenecks in production. Also, at that point, I think we had some of the larger Midwest refineries in turnaround, which just compounded.
So it was 50 under. And if you're a Canadian producer, how do you hedge 50 under?
Well, at that point, you're not going to hedge in that differential, but you can hedge the exposure to the WTI price. So what I would do at that point is probably lock in the WTI piece of it, the exposure, and leave the differential to float. I wouldn't lock in the differential unless it was around that long-term norm of 15 or, right now, and the February production is trading below a differential of $10. But I think that was probably widens out on the forward curve. I don't think anyone expects the differential to trade at this level. Because one thing when the Canadian crude trading is close to WTI, it'll result in some demand destruction. The refineries will be able to find crudes available that enable them to produce at a higher margin. And so they'll shift their refinery slate away from some of the Canadian heavies to other crudes that are available.
When the differential was minus 50, and which meant that the Canadian crude was 25. I think it sparked some action by the Canadian government. Can you talk a little bit about the curtailments and how you see that shaking out?
Yeah, what the Alberta government did at that point is they came out with a plan to cut 325,000 barrels a day from Alberta production. Some of the details of the plan is that it limited to just the companies that were producing more than 10,000 barrels a day. So it just impacts the 25 biggest companies producing in Alberta. Overall, it's an 8.7% cut to Alberta production. So for those 25 companies, it may be, in the ballpark of 10% cut. For this month, for January, it's based on the sixth highest months of production in the 12 months between November 2017 and October 2018. So that, had some, it probably has some unintended consequences. I can see three groups that are hurt with this. it hurt companies that have the refineries, both in Western Canada and in the Midwest U.S., the PAD 2 area, because everyone at that point were clamoring to run as much Canadian heavy as they could, but definitely the profits of refining were hurt by that. It hurts producers that were ramping up production, those that were growing through 2018. And I mean, the province wants people to be investing in growing production, but those are the ones that got hit the worst because they're getting scaled back, not from their capacity level at the end of 2018, but from their average over their highest 6 months of the year. And it hurts companies that had sufficient transportation to move the crude. If you had space and capacity to get that crude to refiners or down to the Gulf Coast, you definitely suffered a loss by not being able to ship to those markets that were paying higher prices for the crude. One thing that the government has done to somewhat rectify the problem of impacting the producers that have been growing is beginning in February, they're changing it from a 6-month average to your highest single month of production. So that is a big step. So the government is listening to what people are saying and trying to mitigate the unintended consequences of some of that, of this decision.
Do you think it'll be extended to the second half of this year?
Well, I think one thing the government has said is that at that point, the storage level in Alberta had reached 35 million barrels, which is kind of twice the required operating capacity. And the plan is to reduce that amount back to more normal levels. And then I think that they plan through the end of the year to maintain a smaller cut of about 95,000 barrels a day. That should allow us to operate at a balance, which I would expect should see the WCS differential move back towards that normal range of somewhere around $15 below WTI.
Well, let's talk about the biggest issue, and you've mentioned it a number of times so far, and that is takeaway capacity. There are basically, I think, 3 big projects still on the boards to add takeaway capacity. Could you talk a little bit about that?
Yeah, there's three pipelines that will do a lot to help this problem. The first one is Enbridge Line 3 expansion. Line 3 is a pipeline that built in 1967 that moves a lot of crude down into Superior, Wisconsin, out of Alberta. They're going to put in an expansion that will add about 375,000 barrels a day of capacity, in large part replacing an older line that is no longer able to transport as much as it did while it was new. And that's one of the things with the requirement for these new lines. A lot of the existing infrastructure is getting old, and you want to put in new stuff that is less likely to suffer leaks and cause environmental problems. That one is right now scheduled to come online by the end of this year. It still will be facing legal challenges from environmental groups in the states that it travels through. But right now, it doesn't look like anything's holding that back from completing on time. The other 2 pipelines are a little longer time frame. Keystone XL, which is intended to flow down towards to Cushing and then down to the Gulf, connect with lines that lead to the Gulf of Mexico. Right now is expected to be online in 2022 and add 830 a day of export capacity. That line was first proposed in 2008, approved in 2010, and different, under the Obama administration, that line was stopped for a time, and under the Trump administration, it's now been approved again. But it's still taking an extremely long time to pass all the hurdles it takes to get a line built. And I was comparing that to the Dakota Access Pipeline, which was first proposed in 2014. And even though it faced some environmental protests as well, it was flowing by 2017. So just the speed with which the United States within the country is able to get pipes going just is so much better than what we're able to do in Canada. The third one that's in the news a lot here is the Trans Mountain expansion. It'll add another 590,000 barrels a day and head from Edmonton, Alberta, out to Vancouver, British Columbia. Right now, the Federal Court of Appeal here in Canada ordered a new National Energy Board environmental assessment to consider the impact of tanker traffic on the wildlife on the coast, as well as ordering meaningful consultation with the Indigenous groups along the pipeline's path. Those reports are due on February 22nd, 2019. And so at that time, we'll have a little more clarity with how that pipeline's moving forward. The Trans Mountain Pipeline was bought by the federal government last year for $4.5 billion when legislative issues kind of kiboshed the planned expansion at that time. So the federal government stepped in to try to make sure that this happens. And just the way things seem to be working here, it almost seems like any pipelines going forward, any new ones after these three might have to be run by or initiated by the federal government just to have the wherewithal to take as much time as it takes. That line's now also expected sometime probably late 2022 to be completed.
Dominic, just a quick side note. I noticed that your central bank mentions oil prices as a reason not to raise rates, and it's just interesting to me how important oil and the prices to the economy in the U.S. They're always looking at a inflation measure with energy and food prices removed from it. So I thought that was kind of interesting. And now the federal government's getting into the pipeline business. It just shows you how important oil is to the economy.
Yeah, it definitely is a huge export for the country, and has been for years. It's interesting that the United States, as it now approaches approximate parity where it's producing as much as it's consuming, it'll be interesting to see if the view on prices in the U.S. changes, that it's not as much a problem when prices rise, because it'll be a boon to the economy, to segments of the economy there as well.
Yes, I think if you look in the past, many of our recessions are preceded by rising prices in crude, and it would be interesting that if a recession is preceded by a big decline in crude, we'll see. It's definitely change going forward. Dominic, just real quickly, who is the U.S.'s biggest import? Who do we import the most crude from? It's Canada, right?
It's Canada, but
by a wide margin.
Yeah, by a wide margin. Virtually all of Canada's exports, which is about 3 million barrels a day, is going to the States.
And Canada is also a big customer of the U.S. of diluent end products that flow from the U.S. into Canada. So,
yes.
What's happening in Canada is critical, as I said earlier, to North American supply and demand.
good point, Andy. I mean, when was it back in 2008 when the Canadian pipeline came into Cushing and helped contribute to the super contango? We had a huge building of storage in Cushing. Are you seeing that as well up in Canada? I mean, is WCS in contango right now, and the curve itself, does it trade much? Can you talk about that a little bit? Like what instead, so are you starting to build more refineries to take advantage of the low oil prices? What's
right?
Yeah, sorry, go ahead.
So it probably would have been more feasible if we saw this long term. It was after the Alberta government came out restricting production. A week after that, they came out and asked for a request for proposal for new refineries. And as I said, one of the big areas of the business that was hit by their decision is the refining, because at 30 or 50, well, clearly at 50, the refineries are making money, any of them that are able to process the heavy oil. But now that has come back down, they're very hard for the refineries to be operating at a profit, any that process the heavy oil that we produce. And we already have sufficient production of products for the domestic market. So if we are to build more refineries, we have to build takeaway capacity for the products. So it really just moves the problem from one transportation area to another. One way or the other, we'll have to get the oil or its products out of the local area.
What, in terms of politics, we were talking earlier, and you came up with a interesting statistic on the number of people that now support pipelines. Which really surprised me.
Yeah, there was a poll that was just out this morning here in Canada that it was a national poll, and 60% of Canadians, support and view it as a crisis if we're not able to add more takeaway capacity. Every province other than Quebec viewed it as a necessary thing for the country. So definitely there's a building consensus that we need this to help the overall Canadian economy. We really are stifling this segment of our economy right now because we don't have that takeaway capacity.
Well, if these three pipelines are built, given some of what you had said, it looks like it's about 1.8 million barrels a day of additional capacity, which should help to match, or correct me if I'm wrong, should help to match the growth in production over the next 10 years, maybe?
Yeah, it definitely puts us in a position to allow us to continue to grow our resources. I think out as far as 2035, I think as far as there's an organization here known as CAP, the Canadian Association of Petroleum Producers, that forecasts out the ability to grow production, or the expected growth in production. And I think at that, I think they have us growing. I don't have the number here in front of me, but off the top of my head, I'm thinking probably to 6 million barrels of production a day by then. So by 2035, we may acquire an additional one, but probably well into the 2020s. Mm-hmm. If we get these three pipes online, we'll be in good shape. The other thing that we have done in Canada to help alleviate the problem is add more crude by rail. Just looking at the last time that we were trading prior to 2018, back at fourth quarter of 2013 and through 2014, we are trading at quite a discount to WTI, and transportation by rail at that time increased by up to 150,000 barrels a day. The nice thing about rail is that those cars can be used kind of transported anywhere where they're needed in North America. Once the oil prices came off towards the end of 2014, the differential shrank, mostly because WTI got a whole lot cheaper. And so the use of rail in Canada dropped back below 100,000 barrels a day by 2016. But last year, by second quarter, we reached 200,000 barrels a day. By the fourth quarter, we were transporting 300,000 barrels a day. So the companies...
200 now?
300.
300.
Yeah, by the end.
Is all that going into... Sorry. Is all that going into PADD 2, or is it finding its way to eastern refineries as well?
I think the eastern refineries, actually, I'm not sure if I think most of it's going down to the coast where they're really set up, the Gulf Coast, where they're set up to run heavies. So quite a bit of the stuff by rail is going there. And I'm not sure if some of them going to PADD 2 or as well or not. Since I've been retired, I'm not quite as on top of that as I've been in the past.
Mm-hmm.
But we're now going to be seeing this amount, another unintended consequence of the cutting the production and causing the differentials to tighten up, is that this crude is less appealing to a lot of the refineries. And so we'll be seeing that rail amount come off here at the start of 2019. Of course, we won't see those numbers for a couple of months, what they're producing, what they're transporting. But that's going to come down from where we were in the fourth quarter, certainly. And I have to say, on the positive side, the curtailment of production has achieved what the government wanted as far as improving the prices. We would definitely be trading well north of $20 a barrel discount right now. I think the 50 was a momentary blip, but I could see it trading out between 20 and 30 through this year if we hadn't taken this step. So the amount of money producers are receiving for their crude is significantly better than what we would have. And so the government will be receiving better royalty payments as well. So there is definitely a positive to the actions of the government. I just, it's unfortunate that it's come to this, because it'd be much better if we were able to get the pipelines built on a timely basis and receive those market prices without this step.
There's definitely a lot of ironies there, Dominic. That the rails are going to the coast where there was so much. I think the rails are going to the coast, and that's where a lot of the how can we put it? The environmentalists were up in arms over the some of the projects that were proposed.
Yeah. Well, that is. I mean, I heard a clip of our Prime Minister on the radio. He was talking to a town hall meeting somewhere in Ontario, and he was saying, it's obvious that shipping crude by rail is less good for the environment because it burns a lot more fuel to transport it, and it's more dangerous that it heads through populated areas and accidents can happen. It's our government recognizes that the safer, more environmentally prudent way of transporting is by pipeline. It's just tough to get it done.
It's also ironic, of course, is that now our government is talking about putting oil sanctions on Venezuela, and the heavier Canadian crude is a perfect substitute for some of the Venezuelan crude, and it's going to become harder and harder or has become harder for us to source that crude here.
It is, and mentioning the Venezuela thing just reminds me of another reason why the Trans Mountain pipeline is so important to the Canadian market, because it allows us access to the Asian market. And at some point, when Venezuela, gets its act together, and then it has huge heavy oil resources as well, and will be in direct competition with it for those Gulf Coast refineries.
Mm-hmm.
So definitely having a second market that we can sell to is hugely important for us strategically, just to ensure that we're getting the best prices available.
Well, I think we're going to stop it there, Jim. I think we'll do another podcast.
Right, this is great.
This has been so great, Dominic. Really appreciate you spending the time with us, and it was just terrific. Thank you so much.
My pleasure. Always great to talk to both of you.
We want to thank our guest, Dominic Proctor, for a tremendous job on the Canadian oil situation. And if you're looking for more information, please reach out to us on the web at www.commodityresearchgroup.com. My email is alebow, ALEBOW, at commodityresearchgroup.com. And Jim's is Jim Colburn, J. Colburn, COLBURN, at commodityresearchgroup.com. And we'll be doing our monthly, probably early next week or midweek. Thank you very much.